Good afternoon, everyone. As usual, we're just going to wait a couple of minutes, couple of seconds until everyone is joining. We have quite a few attendees today, so let's wait a minute before we start. All right, we gave it a good 2 minutes. I mean, over the next couple of minutes, a few more will join, and that's fine the way it is. Well, a warm welcome on behalf of the SCTA Next Gen Council. It is our pleasure and honor to host this, in my opinion, very interesting last webinar of the year, just before we enter the month of December. Just, you know, the game rules as always. We have a Spanish interpretation for the people who feel more comfortable with it. You will see a button on the bottom right where you can click on interpretation, and we will going to record this webinar as usual, so you can see it on YouTube in a couple of days' time. Yeah, the Q&A as always is going to be at the end of the webinar. So if you have any questions, please just use the Q&A button as always, and we're going to try and get to all of those questions at the end of the webinar. Now let's kick off with introducing our panelists today, our speakers today. Ladies first, we're going to start with Jennifer LQ. She is the president of the Eyes in Futures. Currently, she's with us from Singapore. So thank you for joining us so late tonight for you, today for us. And we have Max Kopstake. I hope I said that right. He is the commercial director for Marex, and he is joining from London and has a very beautiful bow tie indeed. So Jen, I would say we can start off, we can kick off. And
Sounds perfect. Sounds perfect. What I'm going to do quickly before I introduce myself, I'm just going to share these slides. Give me 2 seconds to share the screen. Let me know if you guys can see it okay.
Yeah, we can see the screen.
Okay, perfect. Okay, that's perfect. Wonderful. Yeah, I'm just going to do it in this format because somehow whenever I try to do it in the presentation format, it takes over my 2 different screens, so it's easier for me to see myself and speak. Just a quick introduction. Thanks, Max, for inviting us here. I do have a few of my colleagues that are on as well to answer any of the sort of tough, more detailed questions that we might have at the end. I joined as the president of ICE Futures US at the beginning of August this year. I been with ICE for the last 15 years, all of it in Singapore. I've been in Singapore, well, I lived in Singapore for 20 years before I moved into New York, and I had started with the Singapore government, then moved to the NYMEX, and then moved to ICE. Did a bit of the softs market, as well as sort of the environmental markets and oil markets and stuff in Singapore. And when I got offered the opportunity to move, I jumped at it because Singapore has been a long time, but also living in New York is pretty exciting. So I was with the NYMEX still when ICE acquired the New York Board of Trade, which is now ICE Futures US. And they first announced it around September 2006. And I actually remember being in my parents' kitchen at the time, reading it on my BlackBerry and thinking at the time, I can't believe what ICE is doing. And I think I'm at the wrong firm and I shouldn't be at the NYMEX. I should be trying to get into ICE. And luckily, not that long after, I ended up getting a job offer and ended up joining the company, and I haven't left since. NIBOT, when I first was actually at the NYMEX, still had a floor. And I was lucky enough to be able to visit the floor because they had a shared space between the NIBOT and the NYMEX in Battery Park. And I got there before the floor was shut. And it was incredibly exciting to watch it. And the options pit was still quite active at the time. And now really all trading has obviously moved electronic. But it's been quite a journey for this exchange. I'm just going to give a little bit of history here. Let me change one of the slides. ICE Futures US is one of our oldest exchanges in our group. So we have ICE Futures Europe, we have Index in Amsterdam, ICE Futures US, we have a Singapore exchange as well, ICE Futures Singapore. And as we acquired the NIBOT officially in 2007, the NIBOT was actually a merger between the New York Cotton Exchange, which was the oldest exchange that was founded in 1870, and the Coffee Exchange in the city of New York. And that's where originally Coffee C futures were first listed, and it was actually back in 1882. It later became the New York Coffee and Sugar Exchange, and then the New York Coffee, Sugar, and Cocoa Exchange. And clearly they were not terribly inventive with their names. Eventually became the New York Board of Trade, and when ICE bought it, we made it ICE Futures US. It's pretty amazing how this exchange has grown over time, and we cover everything from agricultural contracts to currency, North American nat gas, environmental, and equity derivatives. We're an exchange that's constantly evolving. We're always trying to find better ways to serve the customers and try to find as innovative products that allow for really efficient and transparent price discovery and risk management. And I want to talk a little bit about how ICE has changed, because I think being a next generation or a next gen group, a lot of this it's interesting to understand the entrepreneurship side of ICE and how it grew, because we're really an exchange and a group that, even though we started, some of the exchanges are very old, the company really started in 2000. Our CEO, who's still our CEO then and now, Jeff Sprecher, he had come out of business school and he was buying and selling power plants in the US, as you do. And he found that there was a need for more hedging of the contracts and the power contracts he was trading in these markets. Enron had started at the point in time, but it was really not really, I think, what he had expected the market should look like. And he bought a company called Continental Exchange for $1. And he felt, I'm going to actually start something here so we can be able to hedge these products on a front-end platform. When Jeff first started the company, he obviously needed investors at the time. And one of the stories is that they had about 5 to 7 people working for them. And when they brought investors, Morgan Stanley, BP, and Shell, who were one of the first investors of the firm, they actually hired temp staff to come and fill the office and walk around and make it look like it was a much busier and bigger organization than it was. And then I remember Jeff telling a story that when he was struggling actually to pay for salaries in the early stages, and Continental Exchange, when he bought it, had a number of servers and tech stacks and stuff. So he went on eBay and he was selling these just in order to pay for people's salaries. And it's just trying to think of an exchange and a business that started in 2000 doing that, what we've managed to accomplish in the last 22 years. So as the next generation, trying to sort of see all this you can do in 22 years is pretty amazing. We are now exchanges, but we're also a data company and a mortgage company. ICE really, as the platform, we've always looked at moving from analog to digital. So on the exchange side, that's moving from the floor to a front-end trading platform or electronic. And also it's sort of like moving anything from paper to electronic. So that's what we're looking to do in the mortgage space as well in the US, just out of interest. I want to give you guys on the next slide, let's see, find my cursor here, an idea about the exchange and the clearinghouse business. I've always found that when I talk to clients, if I'm talking to traders, they don't necessarily understand the clearing house and the clearing business. They just kind of trade, and all this stuff happens in the background that they're not aware of. Often the clearing brokers understand more sides of it, but really I find when we're talking to the traders, it really ends up being a focus on what they do, the trading, and just making sure they're straight through processing and things work as easy as possible. But I think understanding how it works will help you to understand the bigger picture. So on the future side, which is what you guys deal with every day, you're using it obviously to manage risk daily, monthly, annually, etc. You're using it to discover prices. You want to see what the market is to basically buy and sell in a way that is completely transparent, and that's what we offer. Something that's on a screen so you know the prices. We offer, I think we sort of covered this in, actually, I'll just talk to it because I don't think I've covered this in the slide. We offer certified inventory. So it's basically coffee from origin countries that are tested, certified, and stored on the exchange. We publish these grading results, which allows you and the market to understand the deliverable supply for the futures contracts. We are the buyer and seller of last resort. We offer the physical delivery mechanism for the exchange of goods. If you guys want to sell coffee, you can get onto the exchange, you can get a transparent price that you see, you can sell it, and if you don't close out your position, you can basically sell your coffee through the exchange. You're guaranteed a sale, provided that the products ends up fitting our requirements. Now, the clearinghouse, it's kind of interesting. If you think of the clearinghouse, I always think of the clearinghouse sort of sitting in the middle and surrounded by our clearing members. Okay, and they sort of act as protection around this. And this is really the piece that helps to manage counterparty risk. The clearinghouse becomes the buyer to every seller and the seller to every buyer. I actually explained it to some of my family members that in a way we're like an insurance company. The clearinghouse is like insurance. If one side can't pay or a company goes into default, the clearinghouse ensures that you're made whole on your trade. I remember through MF Global, when that went bankrupt, or when that went into default, that a friend of mine in the oil markets who I was quite close with, he couldn't understand why I was so busy, because in his mind, nothing had changed. He didn't clear MF Global. So from his point of view, the markets acted exactly the same as they would, even though a major clearing member had defaulted. And that's the whole point of the clearinghouse, that you are able to go in there, trade, and no matter what happens, be able to understand and trust in what you're going to get. We have a number of, as the clearinghouse, we want to protect. So we have this sort of the clearing members and everything. We protect the clearinghouse as much as possible. And we have a number of ways that we do that. We obviously have membership criteria. So when we look at every clearing member, we sit down with them, understand, and they have to meet certain criteria before we accept them in. We look at their creditworthiness almost on a monthly basis, just to make sure that we're continue to be comfortable with them, and they can be put on watch lists if they're not, and they're kicked out and they can't become a clearing member anymore, or they get delisted as the clearing member if it doesn't work. We require initial margin, which you guys would know about as you're doing your trade. So we get that from the clearing members. We also have daily mark to market and get variation margin depending on whether prices go up and down for different trades. We do intraday risk monitoring. So if prices move up or move down quite quickly within the day, we have the ability to go back to the clearing members to collect money from them. We also, as ICE, put a contribution into that, and we look at that as skin in the game. So from the ICE point of view, we just don't depend on money coming from the clearing members and the clients. We put our own money in as well. And so that means that we are just as responsible or worried just as much about the risk as we are about the clearing members, and we share in that. We have default insurance, so we go to an insurance company and get insurance in case there's a default. We have this mutualized guarantee fund, so each clearing member hands us money, and the bigger positions that they have, they'll give us more money, but that basically sits in a clearing fund in case that there's a default. And the last sort of, I guess it's almost like a waterfall. The last piece that we have is powers of assessment. So if there is a default, if we blow through all of the margin that's in there, if we blow through all of the ICE contribution, if we blow through the default insurance, if we blow through all of the guarantee fund, we have the ability to go to each one of our clearing members, and we call it power of assessment, and we can get money from them to then make everybody whole. Okay, so the clearing piece is really an important part that as a trader, you don't always necessarily see. Now, I wanted to talk a little bit, and I touched on this, so the idea of price discovery through futures, and I wanted to dig into that idea a little bit more. As I mentioned, we certify inventory. So the coffee that is exported from an origin country is stated in the rules. So we have these very long rules within in the exchange, in the futures exchange. They're certified, they're stored in an exchange certified warehouse. You can go onto our website, as I mentioned, see it daily. You can see a list of the certified inventory. It outlines the origin, it outlines where it's from, where it's stored, how much is there. So the market can understand the deliverable supply that's available for each of the futures contracts. Using this and other market information, trades will take place, and you can get more and more transparency. It provides traders, it provides brokers, it provides the trade the transparency and pricing information so that they can make the decisions that they need to make with regards to hedging, with regards to managing risk, with regards to any type of trading that they want to do. With this, we also establish a benchmark price, and the idea of a benchmark is quite key to not just coffee, but a number of different commodities, and we distribute that number globally. This allows traders to use this price for coffee and do stuff we call like basis pricing. It allows the physical contract to be indexed to the futures price. And benchmark pricing, as I mentioned, it's used well beyond coffee. We see it in the oil markets, cotton, sugar, orange juice, gas, power, the environmental markets. It's really quite interesting to see how people will look to an exchange for these benchmark prices. This slide gives you sort of a good idea about how the outright price of coffee is calculated. So you have the futures and then you have the basis, and a number of you would be trading the basis, which includes the origin differential, delivery terms, and the contract requirements. Another piece I wanted to go a little bit into depth to is that the exchange becomes the buyer and seller of last resort. So if an owner has excess supply and can't find any customer demand, he can certify it into the exchange and sell it via the futures. So he can just basically go short and not close out his position. Additionally, if there's a tight market, maybe there's crop issues or there's not enough commercial inventory to meet roaster's demand, the roaster can go long on a futures contract, hold it and take delivery. The certified inventory is what is delivered. So the roaster knows that they are getting beans that are guaranteed by the exchange to meet certain requirements. The market, so it's quite, I think that's quite a key piece, that you know exactly what you're going to go and get. And I'll go into a little bit more about the rules in that a little bit later in the presentation. This market, as being a buyer and seller of last resort, also allows for a carry trade. So if excess inventory isn't needed for several months, and if the cost of carry exceeds the futures market, the future spread market that the price is being offered, the owner can then go and sell the futures today and buy back the inventory at a cheaper forward price. I think one of the best parts of ICE is our grading room. We have an office in Midtown at 52nd and Park. And we have a grading room for both cocoa and coffee there. And we actually roast the coffee in Midtown Manhattan with the roasters that came in from the early 1900s. I didn't do pictures, but what I did instead here is I've got a sort of a 2-minute video that our marketing people put together. We tried it earlier. The music doesn't come through, but there's no words. But I wanted to give you guys an idea of what we offer there. And it's worth having an eye and keeping an eye out for these incredibly old coffee roasters that are here. So just give me 2 seconds to share to try to get this video up and running for you guys.
Sorry, I pulled out my headphones in the hope that you guys.
Can you guys hear me now again?
Yeah, perfect.
Yes.
We could hear the music,
okay,
and we can hear
Oh,
you
you
now.
did? Oh, good. Oh,
Yes.
good. I'm happy you guys hear the music as well. That sort of adds to it. And actually, Max, I know Max was there. He was able to come into the grading room. So if any of you guys end up in New York, I guess you can reach out to any of us, and it's definitely worth a tour. And if you're doing any coffee grading, just being able to talk to the graders, ask some questions, is quite an amazing experience. And usually, whenever we're doing grading, I always make sure I go down at least once during the grading process to chat with them. Before I ended the presentation, I wanted to talk a little bit about the dynamics of the coffee market. I pulled up some analysis from the Commitment of Trader reports. The slide that you see gives an idea of the increase in the number of traders, both on the commercial and the non-commercial side over the last 36 years. Non-commercial is certainly growing at a slightly higher rate than the commercials, but is also one of the things I want to cover is that the non-commercials really help to take the other side of the commercial trades. Over time, non-commercials are more present in the market. We actually sort of dug down into a number of the physical markets, whether it's coffee and a number of our agriculture and energy markets. And it's clear that these sort of the non-commercials, they help to provide tighter spreads. They're always on both sides of the markets, and they drive liquidity and make taking prices cheaper for the commercials. We really dug down to when we looked at the liquidity, how many times are they on the side of the market? So when you're looking at the commercials, they might be on both sides of the market 20% of the time, whereas the non-commercials are there about 50% of the time. And we can see it sort of here as well in a second, our position composition, that you see if you're looking at the yellow line, that non-commercials are taking probably about 40% of positions, and we've got the commercials, which are the blue line, taking somewhere just around 50% of that. An interesting slide that I actually stole from a colleague from an older presentation. I didn't really get time to update it. And it was more focused on Robusta as opposed to the Arabica markets on the US side. But I think it provides a very good example of how the non-commercials are active in the market and what happens with them. In this slide, we have non-commercials are sort of are held by about 32% in the Robusta market in about 2020 versus what we were looking at, I was just showing before, in our Arabica markets is about 40%. The first question that when we start looking at this, we want to ask is, why do commercials hedge, right? And we know from that some of them on the production or the consumption side, it's about taking advantage of an opportunity. Well, for others on the merchant and the trading chain, they really want to focus on reducing risk. Producers, we know, are natural sellers of futures because they want to fix or they want to hedge the price of their crops for the next harvest or maybe further down the line. When it comes time to sell the physical coffee, the futures hedge can be brought back and they realize a profit or loss on the physical side. In this chart, we've got this red line, and that represents the Robusta coffee price from 2017 to 2021. Producers that are hedging their crop, they're naturally going to want to sell when the price is high. And in contrast, for roasters who are natural futures buyers at the point of hedging, they want to sell when the prices are low. So you've got this where you got the blue almost big in contrast to the gray buyers versus the sellers. So we know that we've got the sellers that are wanting to buy when the price is high and the buyers that are going to be in low. But what happens in the beginning? Who is there to fill in the gap? And this is really where the non-commercials come in. And this is where the section that, excuse me, makes up about 40% of the market. And these guys come in a number of forms. They're CTAs, they're hedge funds, they're pension funds. They might be short-term investors that want to hold positions for weeks, months, days, or sometimes minutes. They're hedge fund managers that might have a lot of sophisticated information on weather and trade forecasts, and they use that to trade. They might be some system funds that use algorithms to trade. They might be market makers who are basically providing a huge amount of liquidity into the market. This sort of devil beware of all non-commercials, and I heard this from one client calling it the Chinese billionaires. It really has to be better understood that they take on the other side of the risk that commercials are not going to be there. So it really provides liquidity. It really makes market spreads tighter, and it really makes the market cheaper for everybody. To sort of end off the presentation, I wanted to cover a question that I often end up getting asked. And the thing is, just because I'm new to the job, they ask me what surprises me the most about the new role. And in a word, it's really regulation. And it's not about the amount we're regulated, because I understood that, but it's really about the interaction with regulators across all of our asset classes that has surprised me. One of the things I did when I joined, I was told to first, but I also was interested, is I read the rules. And our rule book is massive, and read through coffee, read through cocoa and everything. And the coffee rules are about 49 pages long, and they are not the easiest read. But it outlines everything from the coffee specs to delivery notices to storage and packaging to procedures for sampling coffee. All of this is spelled out in details in the rules, and we are regulated, as you know, by the CFTC. We have, as the exchange, thought long and hard about everything that's in these rules, how we interact with the trade, how we interact with the market and all participants. The contract provides a stable, known commodity, and we work to reduce as many variables as possible. So when there is a delivery, the short position knows exactly what it's going to get. When a firm uses our benchmark, they know exactly what the base case product is. And we work closely with all experts in the market, our coffee committees, on any rule changes. And the changes that we do are well thought through, they're considered, and what is seen as the best for the market as a whole. And we know participants, when they come to us, they're going to talk their book. So part of our job is to figure that out. And I want to emphasize that the coffee contract, like all of our futures contracts, they are constantly evolving. I mean, none of this is stagnant. And this is a contract that started in 1882, and there's no way it could potentially ever be the same as it was in 1882. I also think it's useful for you as a trade to understand that we, as the exchange and the clearinghouse, we see our obligation first and foremost is that to be a service provider to the trade and to offer a product that helps to manage risk. ICE has been always, ever since I've joined and before, was about customer service across all of our product lines, across all of the exchanges. And that's just as much the case for coffee as it is for any of our other products. So I want to say that our doors are constantly open. Whether you want to come see the grading room, or if you have any concerns at all, no matter how big or small, we're always here to talk about it. I hope I didn't go over too much time. Max, I think it's probably over to you. I think you're going to be a little, give a little bit more detailed overview. I'll stop sharing my screen because they probably want to cover something. Okay, there we go.
Jennifer, thank you very much. I happened to see on the video that you presented, there was a spare seat at the cupping table. I'd certainly love to throw my hat in the ring for that one going forward. Yeah, thank you to the SCTA for allowing me to do this presentation. I have a habit of being invited once for these things and never again. So as my US colleagues would say, I hope it's a doozy. Now, the wonderful Sarah is also helping me with the slides. So Sarah, if you'd mind switching over to the first slide, please. So I want to start with who cares? I mean, who cares about probably what will end up being roughly, what, 1 million bags of coffee when all the pendings have gone through? 1 million bags of coffee is what, 1/40th of the Brazil production. I think it's like 1.2% of the entire hedgeable production worldwide. I think I even read it's like 12% of the ECF stocks, the European coffee stocks, it represents 12% of. So again, like, who cares? I mean, I think on a yearly basis, the ICE trades about 2.5 to 3.5 million lots a year. Just to put it in perspective, that's 700 million to 1 billion bags of coffee a year, all to define 1 million bags. So I think I want to start this presentation by saying who cares? And then I'm going to dial it back to the origins of the contract, how it started as a mechanism and a delivery point, and kind of build it out from there. So stick with us. I think we've got various people with different levels of understanding from this call. So we're going to start with the foundations. So Sarah, if we can move on to the next slide. Okay, so let's start with this beautiful picture. These are French merchant vessels which are leaving, and this is painted by a Dutch painter. I'm reading my notes, William van der Velde. And if I've managed to convince you that I'm cultured, I'm not, I Googled it. So what this very, very kind of like old photo shows us, or painting, I should say, sorry, painting shows us, is an exchange. You've got on one side the merchant, and on the other side probably the roaster. And the merchant is about to leave on his voyage to go and get the product for the roaster. And in this time, he's looking to arrange with the client 5 things. And these are so important. He's sitting there discussing the contract, and he's going to look for a fixed quality, fixed price, fixed delivery window, fixed location, and a fixed quantity as well. And at that point, boom, we have our first futures contract. Now, the merchant then takes his half of the contract, goes off and procures the coffee. The roaster is then entitled to then pass that contract on to whoever else is willing to take the coffee from the merchant when the merchant returns. Now, a cool thing happens as the coffee actually arrives back, and it kind of relates to the modern world. We have it as the ship gets close to the shoreline with the physical coffee on it, which, by the way, is the coffee that exactly meets the specifications of the agreement. Now, that merchant is a capitalistic agent. He's looking to deliver exactly what the buyer wants. Nothing more, nothing less, exactly what's needed. And as he approaches, we have something called convergence, cash convergence. As the future of that product, the future is traded between the people who want to take or take ownership of the product, kind of is delivered and settles into that physical product. That, for me, is exactly what the exchange is. It is that settlement into a product which everyone knows and is assured what it is that underlines that product. And I think that's it for this slide. Yeah, Sarah, can we have our next one, please? And then I'm going to dive into those some 5 key points that we discussed earlier. And the first one is where. And I think this one is probably the most important, given what we've just been through. And what this shows is a little purple Marex arrow going from Brazil to Europe. And this gives some way to explain some of the issues we've had in terms of the structure, backwardation, in terms of the market rallying. We've had a freight price, and those prices on the right are from Shanghai to Rotterdam as a standard 40-foot container index. In fact, that freight price got to $14,000 per box, right? And what we have is a contract in coffee, and a lot of commodities indeed, which is settled near the consumer. They're not settled where it's growing, they're settled next to the consumer. And what we had for a time was the consumer was cut off from the origin effectively by a complete global disruption thanks to the pandemic of freight. And so what do all markets do in this scenario? They move to try to solve that problem. They rally in to try and solve that problem. So in other words, the coffee price goes up, the spreads go up to incentivize people to pull the product from the origin and destock into the destination. And I think this point here, the where, is so important, especially when it comes to the delivery mechanism by which underpins the certified contract. And also, just to add to this slide, what we've seen, what we've got used to over the last 10 years, think about it. We've had just-in-time production, low inventories, low interest rates. The whole thing, the whole system has been streamlined to an absolute T. And then we have the most disruptive thing for global markets to happen in the last 80, 100 years. And the market has to react. And I think overall did a relatively good job in trying to price that risk in and bringing that coffee to the market. So anyway, let's move on to slide number 5, please. Okay, so here we have the what. And this is, I've got to apologize, this is from October, but the next one is out on Thursday, I think. So this shows the age of the certified stock. And as you can see, there is a big old line at fresh, which means at 0, which means the coffee's fresh. So this is the age discount on the bottom axis. And on the y-axis, we have the volume in bags. And we've seen a lot of coffee come back we've seen a lot of coffee come up for grading as of late. And we see the cumulative chart on top. And I think what that matters is that what this shows to me is, on average, if I owned all the certs, the average discount is about 260 points, 2.6 cents. And why this matters is because if I today, or you and I, everyone in this call, go out and buy one lot of December future, which is in expiry, I mean, it's gone through its first notice day. We're at that point for December where the future is tied to the cash. If we go and buy one lot, what is that coffee? What does it mean? What's it valued? And this is crucial because if we take that one lot of coffee and we go to the client, the roaster, and say, hey, would you take this off my hands for? The client says, oh, probably 20 cents below the market. Then there is something that needs to change. Either the structure needs to weaken to allow that owner to carry the coffee and to utilize the carry premium in the market, or the market needs to correct its pricing. The market needs to come off in order to make that coffee relatively more interesting compared to what else is in origin. And when we think of a move from the certifies from Honduras to Brazil, we have a recalibration of the differentials between the various origins. And essentially what we've seen done over the last, say, 2-3 years with Brazil becoming a deliverable origin. And I don't want to get too much into the details of that for now, but just essentially to show the overview on it. Next, I want to go into the delivery window. So I'm going to steal something from the Robusta boys. Now, this is a spread of, what is it? This is 7 off. So September, November expiry spread, and we've got 4 different expiries down here. And as per usual, it's a pretty boring spread. Nothing really happens apart from September, November 2020. Now, we had a managed money short covering rally, as the COT showed, and we had a lot of paper come to the market. So hedgers in, I think it was Conalon at the time, came and sold Conalon, and the basis weakened. And everyone sat there and said, oh, fantastic, thank you very much, Conalon producer, we will now ship. Unfortunately, though, the period which it was hedged in, which is the September, the window of time in order to get that coffee on a vessel and the availability of the equipment was limited. And all of a sudden, the spread started to go. Someone at destination turned around and said, hi, can I please have some fresh coffee, please? And the market couldn't provide it. So we had these backgradations which happen in order to pull the coffee from the destination to the delivery point. So I think the when matters, and this is something we all need to pay a lot of attention to. And now moving on to slide number 7, please. Now, this is the quantity. Now, this is a really interesting point because I know it excites and infuriates a lot of people around the world. And I'm going to compare the 2 contracts here. So Arabica. When I come to stop my full limit of Arabica, I'm allowed to stop 500 lots, which represents 141,000 bags. Now, comparable to Robusta, the Robusta stopper limit is 1.2 million bags, i.e. the entire, future certified stock would be stopped in 1 expiry and some. So we can see the difference between the 2 contracts is quite substantial. And on that kind of thesis, if you thought about similar rules for Arabica as Robusta, you could imagine how much more the market could have done back in October, November in order to break the Brazil basis with those rules. But anyway, nonetheless, we have our 500 lot rules. And I think that goes to show somewhat the dynamic playing out on the screen. You have the slightly larger boned gentleman on the left, lifting up the lighter guy on the right. And what's it trying to show is, well, if I'm an issuer, which to me means I'm going to deliver coffee against the exchange, then I can deliver as much as I like. But to stop, I can only stop 500 lots at a time, which means that usually in expiry, especially if we have a diverse ownership, you can have a market which sinks into carry. And I think that's really important. And if we go back to put it in context, we go back to a market where we used to having like 2 million bags of coffee, right? How long would it take you to aggregate ownership to turn around to the market and say, oh, I'd like more fresh coffee, please? It would take 14 expiries. If I was to stop the deck, I'd be finished aggregating my ownership by, let me see what I know here, July 25. So that goes hopefully some way to explain the 2 differences and also what that means for the 2 other things we trade, which is basis, i.e. differentials, and flat price. So if the spreads won't do work, as we've seen previously up until fairly recently, usually we've seen the spreads and the basis do work. Likewise in Robusta, when the spreads do more work, perhaps it's the flat when the spreads do more work, it's the flat and the basis. So anyway, I hope that goes some way to explain that point on the quantity. And slide number 8, I promise, or next slide, please, Sarah. I promise that we're not going to be here for 3 hours and a 500-page slide deck. I'll be as brief as possible. So now we're going to move away from the basics and kind of move into where we are now. what we've seen over the last few months, which has been so interesting from a kind of educational perspective, and I generally feel the last 2 years as a coffee trader has been a hell of a ride. And what we have here, these are the pendings, right? So these are the change in the pendings every day on purple, and the black line is the certified stock. And we see as the pendings gone up, certified stock's gone up. And I think this is quite interesting. So I want to delve into this a little bit more. So pendings as of last night, 483,000 bags. And we've had 258,000 bags graded already. Of that, the pass rate has been 77.53% approximately. So again, we can roughly see certs going back to 950 million bags. And the next point is, we've all had the discussions in the market about the delivery coffees, the coffees that can come for delivery. And we were aware during the rally during the period in the lead up to the last SCTA meeting in Switzerland, that there was some talk of a delivery volume. I can't remember what it was, 7,000 bags. Needless to say, the structure and the flat price have done enough to deter that delivery, or to be more precise, have probably made it more commercially interesting to use that coffee elsewhere. To have it commercialized to the roaster. Right, so moving on to the next slide, please. Now, these are the Marex Spectrum. Oh, sorry, we're just Marex now. These are the Marex S&D numbers. And I'm sure a lot of people will contest them, but these are just released now, latest quarterly report, I think 2-3 days ago. And they boil down to one important line, which says balanced split at the bottom there. And that's split between Arabica and Robusta. And of all the other numbers above, I'm not entirely sure how many people will contest the tightness of both those numbers in 22-23. So Arabica is minus 1.6, Robusta is minus 1. And a lot of the Robusta will be used to fill some of the issues in the Arabica balance sheet. We all know that, we've all understood that, we've all discussed that. It is tight. And just going back to that seesaw analogy, if we see the market rally for whatever reason and certifieds come to the board, they're probably going to need to be used. In other words, we've seen, or we will see either the origin stock up and the destination run down, or the destination destock to the origin. But one way or another, the coffee's needed. And I think that takes me on to the next point, which is we've also seen a massive CTA, commodity trading advisor, inflow into coffee recently, which I think has caught a lot of people off guard, and we've seen it in various other markets. This crushing effect where perceived fair value is shifted so rapidly away. And I want to look at that from what we think and what we feel could happen in the future. If that stays in front of the farmer and effectively takes the hedge flow in front of the farmer, why shouldn't we see that the origin differentials remain relatively firm compared to what the base is at destination? And the incentivization structure come in to take the destination stock, i.e. the certifieds, and to gradually reduce them. Which I think brings me on to my last slide, Sarah, if you can, which is what we think the certifieds will do, given what we've seen across other markets, which is, I've rebased this to 100 to say, okay, as of Jan, whatever certs we have, that's 100%. And I think what we're likely to see those certs draw down to a period, which I think, and please afterwards feel free to debate me on this, could be the tightest Arabica period for certifieds, for stocks, for everything that we've seen in a decade. And then the subsequent, obviously, rebuild in Dec Jan, perhaps similar to how 2020 was, the market rallied to break the origin differential to encourage a normal delivery mechanism. And that takes me to my final slide, which is just to say thank you. And, us here at Marex, futures options, liquidity executors, we have algo tools with veteran liquidity providers. I think one of our execution guys is older than I am. And he's extremely good at it. Customer service is at our core. Our research is everything from quantitative to fundamental. And then also the clearing and risk management side. We have online portals to help with all that stuff. And then finally, just to say thank you to everybody for having me on. Thank you.
Thank you, Jen. Thank you, Max. Some very interesting presentations indeed, about a very hot topic that we have on our hands tonight, or today, wherever you are. We have a few questions, and unsurprisingly, these are more or less centered around the grading activities currently, the regradings, etc. So please, for everyone who's put the questions down, please allow me to put them all together and bundle them a bit. To be fair, whoever is wanting to answer those is free to do so. I'm not aiming at someone here in particular. It's more about how do we see the current rate of the grading activities and the extreme high number of gradings, and there is a certain probability or a high probability of them being regradings, meaning old coffees in a way. So whoever wants to answer that question, please feel free.
Tim, I was going to get, yeah.
Yeah, sorry.
Tim, I was going to get you to do it.
Get myself,
So,
yeah, sorry. I had to
okay.
unmute myself there. I'm not sure, Max, quite what the question was, to be honest. I mean, we do have a historically high volume of cert stocks or stocks pending cert. We've been chewing through that since the beginning of November. We do not disclose whether the pending certs are bags that have previously been certificated or not, so we don't comment on that. We do publish, Max was able to use the data that we publish each day on what current stocks are and what pending stocks are. What was the question?
The question is, it feels like, and a lot of those questions we just received, aim at that, is more around, there are a lot of regradings taking place. That's at least a rumor or a theory that's circulating around the market. And what is the ICE doing in order to work against that, so to say?
That definitely is a rumor that's going around, and we've seen it a lot in conversations that we've had with market participants and also in some of the media. But again, it's not anything that the exchange either confirms or corrects. We publish neutral numbers on what is pending. We don't publish numbers on what of that was previously certified at any point in time. In terms of what are we doing about it, what we do about it is what we've done for the last 50 years. When a lot comes up for grading, we follow the same process to sample that lot and grade that lot to the same standards, whether it is the first time that coffee is coming through the grading room or not the first time that coffee is coming through the grading room. And we do that whether it is a lot that has just arrived from origin or whether it's a lot that's been in store for 2 or more years. The exact same standards that are used to in the grading process, in the grading room, for any lot, are applied each time a sample comes in.
Right.
And if the lot has acquired, if a lot has been sitting in storage for some period of time, whether it was previously certificated or not, if it's picked up an aged flavor in the cup, it will fail grading.
Okay. Yeah. So you compare the pendings against the fresh crops, but would you know if it's regraded or not? Is that an information that is available for you?
We can do the research on that. It's not information we routinely pull.
Okay.
Because again, we are applying the exact same process in sampling and the exact same process and standards in grading if a lot has come back as we would the first time it comes through.
Great. Thank you for answering that. We have a question. Yeah.
Just to jump in there as well. I mean, to add, the market is constantly trying to price in everything, and part of that presentation we show is exactly that. Our job as market professionals, and which I hope might be classified as one of them, is to try and work out what the price needs to do for whatever reason, whatever is underpins the actual contract. If it is coffee that is going for regrading, which the market perceives to be of a different value, then the market will adjust. Our job is to try and get in front of that, which is difficult, but that's why we're employed. That's why we have purpose. That's why we have work. And I think sometimes that's kind of forgotten about. Is okay. Well, this is the fact. What do we need to do, or where do we need to be positioned in order to optimize that fact? That's one thing I just want to add. Thank you.
Thank you. Appreciate it. We have a question which is a bit more detailed, and it's coming from Indonesia, at least it seems like, and it's saying, hello, can our Indonesian Arabica coffee can be accepted as certified stocks? I don't see our country on the ICE list. What could be done about that?
Sorry, I'd taken myself off back onto mute again. Adding an origin is something that we do occasionally. I think Max mentioned that we over time had added Brazil. Brazil had not been a deliverable origin for most of the life of the C contract. But as Jen mentioned, we have a coffee committee that advises the exchange on changes that we should make to the contract rules. Adding an origin is a rule amendment. If there's a sufficient interest on the part of the trade to add Indonesia as a deliverable origin, that's something that we would consider. And we would, the consideration would involve conversations with the coffee committee based on their experience over time with volumes of product exchange quality beans moving to delivery points, and something we could look at.
Right, and in that coffee committee, you also discuss about potential changes in the differential, right, or the port discounts, as an example.
Yes. Again, to your point, Max, the port discounts and the origin differentials are also all spelled out in the rules. So any change to those involves a rule change. And one thing to note with that is that under the U.S. regulatory system and the exchange rules, when we do make a change to the rules, if it's deemed to have a potentially material impact on the value of the contract, and usually adding an origin would be, or changing origin differentials or port differentials would be, that change typically takes effect 2 years after we adopt it. It doesn't take place immediately. So there's a phase-in period where the market becomes aware of the change and can begin to price it in more than 2 years out the curve, but it takes, again, 2 full years for that type of change to become effective.
Right. Okay. Thank you. Appreciate it. I think we're all set. If you guys have any other questions, please put them in the Q&A. As I was saying, I've put down a few questions, combined them together as they were all about the regrading and the certified stocks. Let's give that another 20 seconds or so, and if not, then I think we're good. All right, it seems like we're good for today. Thank you everyone who has joined us tonight, wherever you are. Thank you, of course, to all the panelists who have taken part today. As I was mentioning before, we will have the recording up on YouTube. So if you've missed a part, if you want to dig into something, just click on the YouTube recording. We will send out the link in the next couple of days. Thank you everyone for joining. Wishing you a great rest of the day. Thank you. Bye-bye.
Thanks so much.